You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hey everyone, welcome back to another episode of Market Champions. Today we've got Francis Coppola. Francis, could you tell the first off, thank you so much for being on the podcast. I'm really excited to do this. Could you tell the audience a little bit about your background, what you do, and sort of your journey through the world of economics?
All right. Well, I'll start by saying, I'm a singer, really. Yeah, you didn't want to hear that, did you? But I really was a singer first. It's like a long time ago, I went to the Royal College of Music and pursued a career as an opera singer for a while. And I still teach singing and music generally. But I fell into banks at some stage, mainly to earn some money, and stayed there for quite a long time. And then I did an MBA with a specialism in finance and risk. Then I carried on being an opera singer. And then after the financial crisis, my brother introduced me to Twitter. This was a big mistake. And then he said, "Do you have a blog?" And I went, "What's that?" And so I, at the time, it was just after the financial crisis. So what everybody was talking about on Twitter was banks. Now, I knew about banks. I'd worked in banks. I'd done an MBA. I'd worked in IT as well, because in banks, I actually worked in systems and business processes, so that are kind of on the boundary between IT and the business, which kind of means you get to know the plumbing. You understand how it works rather than than sitting in a corner and doing your bit of it. So people who've worked in IT or people who've worked in business process like that tend to understand businesses very well. And that's true of banking as well. So I knew about banking. And there was a lot of stuff being talked about banking, which just made me go, no, it doesn't work like that. And so I was one of the people after the financial crisis who was making the case for banking does not work the way that it has been traditionally taught in economics or even in banking. That economists don't understand it, the general public don't understand it, and worryingly, a lot of bankers don't understand it. And we were making the case for, we actually need to explain how it works. And that's what I and several others spent several years doing, was explaining how banking worked. There was Steve Keen, there was Cullen Roche, there were quite a few of us, and also some of the MMT crowd as well. We'll come to that in a bit. Spent quite a long time explaining how banking works, so that people could understand it. But that was like 10 years ago, right? More than 10 years ago now.
Yep.
And central banks got in on the act eventually, and the Bank of England came in and published a paper in its quarterly review. So it represented the Bank of England's own views rather than just a working paper by some of its economists, where they're going, well, that's their views, but it's nothing to do with us, which is what they normally do. It was actually their own views, basically saying that banks don't lend out deposits. They don't lend out reserves. They create money when they lend, and actually walking through exactly how that works. And they looked at it both in the pre-QE era and how it works now that we have QE, the era of excess reserves. At that time, they didn't get it quite right. The QE side wasn't quite right, and there's been more work on this since, including by me. But I think we do now understand better how banks work, kind of within monetary economic circles. We understand better now how banks work. But I think it's fair to say that outside those circles, there's as much ignorance as there ever was. And I'd have to say one of the most ignorant areas of all is the crypto world. They literally haven't a clue, and it really bothers me hugely that these things that I have spent so much of the last 10 years trying to debunk keep coming back and hitting me in the face again.
Yep.
No, banks lend out deposits. No, they don't. Banks lend out reserves. No, they don't. Bank reserves are the same as the structure of an MMF. No, they aren't. And so it goes on. A crypto developer, very prominent one, saying to me on Twitter that Tether's attestations, Tether's reserves, as much as we know about them, he said, well, that's pretty much what you'd expect a full reserve bank to look like, wouldn't you? And I went, no. That's a fractional reserve bank, not a full reserve one. He seemed to think that a fractional reserve bank had a balance sheet that didn't balance. So we're really down back at the basement of, abject ignorance of how banks work and even how the financial system works more widely, what central banks do, and how that ties in with macroeconomics and the macroeconomy. The level of ignorance is absolutely shocking among people who think they are reinventing the financial system. And I scratch my head and going, I worked in IT. And when we used to design systems, if we were replacing a system in a bank, you would start off by finding out what the existing one did.
Yep.
And how it worked, because that way you knew what the problems were.
Yep.
And then you would talk to the users of that system. Yeah, and their bit of it and the frustrations that they had with it. And what the design you would come up with would be attempting to create something that was better than the existing system rather than just a replication of it with minus all the fixes you've put in over the years to try and make it work better, which seems to be what we're doing with crypto right now, is reinventing the existing financial system, but without all the protections and fail-safes we put in to try and make it safer and more effective. Well, how is that progress? So at the moment, I just feel incredibly frustrated at the state of play in the Wild West of finance. And I have to say, I'm not all that keen on where we are, even in mainstream finance, because the heady days when people were beginning to get it, beginning to understand how banks work and what central banks do and things like that, seems to kind of died down a bit. And now we're getting back to where we were before, with people still thinking that banks lend out deposits.
Yep.
And I'm going, oh no, not again. Many times. So at the moment, I'm engaged in trying to write a book about the basics of banking. Mm-hmm. Because simply for that reason, intended for general consumption, not as an academic textbook, although there's a need for one of those as well.
Mm-hmm. Got it.
So is a long and long rant there, and I hope you don't mind, but I hope that tells you something about me and my background.
Absolutely. And when you sort of talked about how most people don't understand the banking system, I think you sort of hit the could you start off by sort of describing, so what does the central bank actually do? So when people talk about central banks doing QE, so what does that entail, and what does that really lead to?
Well, QE, it kind of depends which version of it, but the kind of QE that most people mean and that most people are familiar with and is most often done is what we call large-scale asset purchases. You'll see them called LSAPs, which is actually a better name for them, really. And what they do is they involve the central bank going out into the market and buying large quantities of assets. As the name suggests, large-scale asset purchases. They're not buying those from banks. They are buying them from market participants. That might include banks, but it's not limited to banks. In the case of the Bank of England, right from the start, when they first started doing QE back in 2009, they thought that one of the principal ways in which QE was supposed to work actually wouldn't work very well because the banks were in a mess. So they decided to avoid buying these assets from banks. They bought them from investors. And the idea was, and I think it's important to understand what the purpose of this is, because the thinking on this has changed over the time we've had QE, and it's worth going through what they thought it would do in the first place and where we are now with it. And secondly, I think that, again, among many of the people I talk to, and particularly in the crypto community, there is this obsession with monetary aggregates, with the supply of money. But QE isn't fundamentally about the supply of money, at least not, certainly not in the sense of creating money, printing money, as it's often called. It's not actually about that. And in fact, the kind of money that QE directly creates is what we call bank reserves.
Yep.
It's only available to banks. And so when they started doing QE, most central banks, with the notable exception, I have to say, of the Bank of England, which, like I said, right from the start, decided this wasn't going to work, rightly, were proved right. Most central banks assumed that increasing the quantity of reserves available to banks meant that the banks would increase lending. That's what it was all about. It was all about getting banks to lend. And in fact, interestingly, so just reverting back to crypto for a minute, that famous line on the Genesis block, you know, the one on the 3rd of January, which happens to be my birthday, actually, saying Chancellor on the brink of another bailout for banks. That, if you read the actual article, Times article, which is still online, it actually tells you it's not about QE at all. It's about the Chancellor doesn't directly control monetary policy in the UK. The Bank of England is independent. So this is the equivalent of the Treasury Secretary, basically saying, should we put some more money into the banks one way or another to get them lending? Because we need to get the economy moving again. And the way to do that is to increase bank lending. Now, QE, the Bank of England wasn't doing QE at that time. What they were thinking about doing at that time was cutting interest rates further, again, to try and encourage banks to lend. Right. So we were looking at more taxpayers' money for banks. We were looking at interest rate cuts, all of it intended to try and get banks lending again, to get the economy moving. That was what it was all about. And you see, it's not fundamentally about money as such. It's all about lending, credit, because we're a credit-based economy.
Yep.
So that's where we were right at the start. A lot of interventions at that time. I mean, that particular one wasn't QE, but other central banks like the Fed and the ECB, not the ECB. ECB didn't do QE at that time, but certainly the Fed a lot, and the ECB later, when it started doing QE, a lot of the argument was that giving banks all this additional funding would mean they'd lend more, wouldn't they? Well, those of us who knew how banks work kept saying throwing money at banks doesn't make them lend, because banks don't lend out reserves. Reserves are about payments. They're not about lending. Yep. You see, so banks need as many reserves as they need to make payments, but they don't need reserves in advance of lending. So giving banks lots of reserves in advance of lending, they'll decide whether to lend based upon their in-house criteria, which will be the balance of risk versus return, right? So they won't lend if the risk is too high versus the return they expect to get. And there are lots of parts of that. At the time that these central banks and governments were trying to get banks to lend, we'd got regulators on the back of damaged banks that had failed and being kind of hauled up by the scruff of their necks with injections of taxpayers' money, and everybody hated banks and bankers. And nobody wanted to make banks take risk. All the debate, apart from this, we've got to get banks lending, but they mustn't take any risk. Right. We've got to make them safer. And I'm going, well, that doesn't kind of work. Just how do you make them safer and get them to lend more? And then people went on about small businesses, and I went, small businesses are about the riskiest form of lending there is. What are you talking about? And first-time buyers.
Yep.
You aren't kind of getting this. The degree of kind of inconsistent thinking around this time was quite extraordinary, and so those of us who were saying, well, banks will start lending again when their balance sheets are repaired, and that might take quite some time. And in the meantime, they're going to be selling off a lot of assets, which they were, and the regulators are going to impose capital requirements on them. We talked a lot about bank capital at that time, which is not money. it's the gap between assets and liabilities. In any solvent business, you're supposed to have a gap between your assets and liabilities, right? You're supposed to have more assets than your liabilities, so that in the event, so that you can always meet your obligations, right? Well, in the case of the bank, in the banks, before the financial crisis, banks didn't have much in the way of a gap between their assets and liabilities. So when asset prices fell, the value of their assets fell, all of a sudden they became insolvent. Which is not a good situation. So a lot of what the regulators were doing was, on the one hand, saying banks have got to have a larger gap between their assets and liabilities. And a lot of them, because when you're doing working out the size of the asset side of a bank's balance sheet, you actually take the risk into risk of default and market risk and interest rate risk and that kind of that into consideration. So that you need a larger gap. Kind of the more risky your assets, the larger the gap you need. Does that make sense? Right. Yeah. So regulators were on at banks to increase their capital, and they could do that by de-risking their balance sheet, so reducing the quantity of risky assets they held, or by various other means of recapitalizing, reducing their liabilities, and increasing shareholders' funds, so rights issues and that kind of thing, and also the recapitalizations, the bailouts. So regulators were on at them to do that, and there's been a lot of work done on bank capital by the Bank for International Settlements and by central banks and regulators. And on the other side of the balance sheet, a lot of work on liquidity, which is about making sure that banks always have enough money to make payments. Right, and they've done a lot of work on that as well. We have what we call high quality liquid assets, which banks are obliged to hold, which are designed to ensure that whatever happens, banks can always make payments. Even if they're actually technically insolvent, they can still make payments. And that's what that's all about. And even markets are frozen, they can still carry on paying. Because one of the big changes that's happened in the last 50 years, in my lifetime, is that we've become dependent on banks for payments in a way that we never were 50 years ago. 50 years ago, most people operated in physical cash. Now most people don't. They operate in using contactless payments and things like that, which are in Western countries are all intermediated through banks. That's not true in developing countries. In developing countries, the payments are much more likely to be intermediated through, phone companies and platforms of one sort or another. But in Western countries, it's all intermediated through banks. So banks have become the gatekeepers to the payment system, and they've become a mission critical 24/7 operation, so such that if a bank's IT systems go down and the payments are out for even a couple of hours, people can't pay essential bills. And then there's a big hoo-ha about that. Now, we weren't in that state, even 50 years ago. It wasn't like that. So that's another big change that's happened just in the last 50 years. Actually has made banks more fragile in a way and more essential. And the whole function of liquidity in banks is all about ensuring that the payment system doesn't go down. You see, and you notice I'm not even talking about lending now. I'm talking about payments. Just people making ordinary payments out of their out of their bank accounts from their wages with no lending involved. And it's about making sure that banks can always do that. So huge changes. So that was really what the focus of regulatory activity in the last 10 years, a decade or so has been. So banks are under pressure really to make their balance sheets safer and improve their liquidity. At the same time, as governments were on at them to lend more and throwing money at them to try and make them lend, but it was the kind of money they need to make payments, not the kind of money they need to lend, because banks don't lend out reserves and they don't lend out deposits, because what they do when they lend is they create a deposit. And so the whole basis of how banks work, the whole direction of policy was kind of influenced by a mistaken understanding of how banks worked. And then it became apparent over the course of the next few years, the recovery wasn't going as well as it should. And year after year, people kept saying this is because the banks aren't lending. Why aren't the banks lending? We're giving them all this money. Why aren't they lending it out? Even as recently as 2014, we had somebody at the Federal Reserve asking why aren't they lending out all these reserves? And I was going, oh no, not again. And that was about the time that the Bank of England produced its paper saying, actually, they just don't lend out reserves. It's not how it works, which was a huge relief. And even then people fought it. So now moving on from that, the thinking around QE is different. Now we tend to think of it in terms of influencing interest rates and portfolio adjustments. So the idea behind QE is that when you're at the lower bound of interest rates, I mean, you know that you can't drop interest rates much below zero because otherwise people will switch to physical cash, which has vaulting costs, storage charges, but which amount to a small negative interest rate. But if you go below that, then they'll opt for physical cash instead of taking the hit on holdings of cash in bank accounts. Yeah. So when they reach the lower bound, what central banks do is QE, which has the effect of depressing market interest rates below the policy rate. And it affects interest rates not just at the short end of the curve, it's where it's directly influenced by the policy rate, but also along the curve. So they can influence the policy rate at any maturity. And one of the effects of that is that central banks can flatten interest rate curves. They can flatten yield curves. And we've had flat yield curves directly caused by various forms of QE, LSAPs, as I've mentioned, but also by things like Operation Twist, which is explicitly an asset swap where you're where the central bank is buying long term and selling short term.
Yep.
Yeah. Or vice versa, whichever way around they want to do it. It's a way of influencing the shape of the yield curve,
right?
If you see what I mean. So now we tend to think of QE more in terms of portfolio adjustments, because what you want QE to do, what central banks are trying to do, is influence aggregate demand in the economy, which is the spending choices that people make. So the idea was to get investors to switch out of safe assets, out of government debt and other types of safe assets, like in the US, agency mortgage-backed securities, for example, into riskier assets, which might include corporate debt and equities. And that would depress not only the rates on the safe assets, but also the rates on those riskier assets. And thereby make it easier, make it cheaper for corporations to fund investment. In more investment by corporations results in more hiring, it brings down unemployment, it maybe makes it possible for corporations to raise wages. It was all about that. That's where the thinking shifted to, was maybe we can influence what corporations do. Maybe we can get more investment, maybe we can get unemployment down by getting corporations to do more. It was kind of a qualified success. There is some evidence that QE did contribute to falling unemployment, at least in the States, and maybe in the UK as well. But we're not clear how much effect it had. And the thing is, it's all complicated by the interrelationship with other forms of policy. So government, fiscal policy, for example, and monetary policy are very blurred when interest rates are on the floor. And QE has fiscal effects, one of the most notable of which people complain about a lot, is actually the wealth inequality that it causes. Because obviously asset holders tend to be wealthy people or wealthy corporations, or So if a central bank is buying assets out in the market, it's buying assets from wealthy people. The effect of a central bank buying assets is it drives up the prices of those assets. Yield is approximately the inverse, drives down the yields and up the prices, because yield and price are the opposite of each other, kind of. And so we've seen stock markets and bond markets and lots of other markets, any old assets, soar as a direct consequence of QE. It is an intended effect of it, that it should raise asset prices, not just safe assets, not just the assets the central banks are actually buying, but assets across the board, because investors switch into the riskier assets, and that brings down the price of those riskier assets. So it's intended, it's an intended effect. People talk about it a lot and say it's not fair and markets are in a bubble and all the rest of it. I'm going, yeah, it's an intended effect. It's supposed to do that. The criticism that I make of it is that the relationship between that effect and what actually goes on in what people like to call the real economy, which is, real households and real shops and businesses and so forth, is tenuous. It's what we call trickle down economics, really, where what goes on in markets somehow trickles down into ordinary people's lives, and it's questionable how much it trickles down. Like I said, there's some evidence that QE has reduced unemployment. There's not a great deal of evidence that it's increased business investment, so I'm not entirely sure how it's increased unemployment, except that there is this question, sort of kind of productivity question, whereby, again, there's some evidence that companies have employed cheap labour instead of investing in capital, in kind of plant and machinery and so forth, and that's not necessarily a great situation either. So it kind of all relates together. So that's a lot of the criticism of QE, is that people don't really understand its effects. I still hear people saying it didn't make the banks lend, to which I say, well, that wasn't really what it was intended to do. That's not how it works. It works primarily by influencing portfolio decisions by investors, and affecting market yields and asset prices. That's what it does. It's intended to raise asset prices, and it's very effective at it. The question we then have to ask ourselves is whether that's an effective way of stimulating an economy, and I think that there are real issues with that. But once we kind of understand better what it does, I think it's easier to work out what's the best use of QE. My view is that QE is best used in a situation where you've got a potential deflationary asset price collapse, like the 1930s, as we had in after the Wall Street crash, that one. Also 2008. When we were facing potentially another 1930s collapse, it was similar to the Wall Street crash. The QE is very effective at stopping that because it effectively puts a floor on asset prices, stops them collapsing. It's very good at that. And the third time, and this might surprise you, we've had that again, was actually in March 2020. And QE was the right tool then too. That I think a lot of people don't tend to talk about that one because we were all so obsessed with the pandemic, with COVID at the time, that we didn't actually see what was going on in markets. But when we were on in markets, it was like a repeat of 2008. It was a massive panic. Everything froze. Asset prices were in free fall, and QE actually does stop that. And the central banks did intervene to prevent a disorderly collapse at that time, and that was a perfectly reasonable thing to do in the circumstances. Where I think QE falls down is when it is then used to try and kickstart economic growth, especially when the fiscal authority is cutting spending, tightening, and particularly targeting its cuts, its benefit cuts and tax rises at the lower end of the income distribution, which is the end of the income distribution that is least affected by QE. So you've, at the same time as you've got QE raising asset prices and increasing the wealth of those at the upper end of the income distribution, you've got a fiscal authority reducing the incomes and therefore the wealth of those at the lower end of the income distribution, and surprise, surprise, wealth inequality widens. So that's a lot of the problem. Is, I think, the ability of monetary policy generally to offset what fiscal authorities do is very limited indeed. And we need to look more carefully at what the best use of QE is and what other tools are available to central banks and indeed to governments to help their economies out of a mess.
Yep. And I think you sort of cleared up, a lot. So, reserves are sort of, people, banks don't lend out deposits, they don't lend out reserves. They lend, sort of when they view the risk reward as being right. And, so I think one of the questions that came through Twitter, which I thought was interesting, is, could you sort of, differentiate again, reserves versus liquidity, versus money supply. Because, you mentioned at the start that, there's a lot of people who just talk about the monetary aggregates, like, M2
Yep.
or, Fed's balance sheet. And, those are relatively meaningless. And so, in your opinion, so what's your, preferred indicator of money supply?
Okay, can I just talk through how we measure money? Because I actually
Sure.
think this is the fundamental to everything, and understanding
Absolutely,
what these monetary aggregates are, because I'm constantly being sent pictures of monetary aggregates, and usually by people who kind of haven't quite understood the point. So if we start, there are various forms of money measured by central banks. The first, and the one that gets talked about a lot, is what we call the monetary base, or M0. Now that consists of two things. One is physical cash, notes and coins, currency, and the other is bank reserves. Now, in days gone back, back when the animals could talk, of course, it was all the same, because even banks, their reserves would be made up of physical notes and coins. And to a small extent, they still are, because banks have to fill their ATMs. So a little bit of their reserves will be physical notes and coins, just in their vaults for that reason, so that they can dish out physical cash when they need to. Yep. But the majority of bank reserves, now that we live in a world of electronic payments, the majority of bank reserves, and by far the largest part of M0, is electronic reserves. Okay. Yep. What banks do is they have deposits in accounts at the central bank, what are known as reserve accounts, and what's in those reserve accounts is bank reserves, nothing else.
Yep.
Nothing else is ever bank reserves, only what is in those deposit accounts at the central bank. That's what we mean when we talk about bank reserves. That's what we mean. Now, like I said, I know that there are also a small quantity of physical notes and coins as well that would be counted in bank reserves. But what is not counted in bank reserves is things like treasury bills, gilts in my country, government bonds,
yep.
Commercial paper. They may be short-term cash equivalents, but they ain't bank reserves. And I think if people could understand that, the bank reserves are a very specific thing. So when we're talking about a full reserve bank, we're talking about a bank that has sufficient money in its deposit accounts at the central bank to enable everybody who is a depositor at that bank to withdraw all their money all at the same time. That would be a full reserve bank. A bank that had commercial paper or treasury bonds or whatever to the value of all of its deposits would not be a full reserve bank. It would be what we would call a narrow bank, but it wouldn't be a full reserve bank. But what we mean by bank reserves is very, very specific. It just means the deposit accounts at the central bank. If people could get their heads around that, I think it would help. So that's M0, and when we count up, the measures of money are a bit like Russian dolls. They all fit inside each other, but bank reserves are only counted in M0. They're not counted in any other measure because they're not in circulation. Nobody except banks ever touches bank reserves. No ordinary person, bank customers, and nobody ever touches bank reserves. They are just used for movements between the holders of reserve accounts, banks in other words, and maybe a few other institutions that have reserve accounts. So the Bank of England does allow some other institutions that are not banks to have reserve accounts. So potentially, though they would have bank reserves as well. So, and banks can make payments to each other across the books of the central bank, the reserve movements, and that's actually how we settle, how they intermediate payments, all electronic payments done through banking systems are intermediated in that way. But it's still just a movement between banks. The customers get something else.
Yeah.
Well, the money that we use isn't that. Right. The money that we use, right, apart from the part of M0 that is notes and coins, the money in our deposit accounts in banks is M1. And then there's that's in demand deposit accounts, broadly speaking, and then M2 includes savings accounts as well. So broadly speaking, the money that we use every day is M1, and the money that we have that we might not use every day is M2. I'm simplifying hugely here.
Yep.
Things like MMFs as well feature in broadly in the kind of M2, M3, M4 nexus.
Right. Yep.
So for those who keep their money tied up in things that aren't banks, some of them feature in measures of money as well. But it brought that group of M's together, M1, M2, and for those central banks that report it, M3, M4. The Fed only goes as far as M2. ECB does M3, Bank of England does M4. I look at it and think, you're just adding bits on. But it's basic. We call that broad money. But really, we should say kind of everybody's money, because that's what it is. Right. So M0 is bank money, and everything else, and M1 to whatever is everybody's money. It's the money we actually use every day, all the time.
Yep.
Okay, does that help?
It does. It really does, because most people sort of mix and match the different money supplies. They look at M1 and go, oh look, M1 is up 20% year on year. We're about to see hyperinflation or something. So it's definitely very, very useful to the discussion that you sort of just gave. It's absolutely wonderful.
Yeah, and I think it's important actually, kind of which M does matter. M1, when the M1 rises exponentially, that could be a problem, because M1 is moving money, it's demand deposits. It can run. But when we're talking the other forms of money, M2, M3, M4, there's a lot of things in there that can't easily run. So things like savings deposits are often what we call notice accounts or time accounts. And you can't easily get your money out of them. You lock your money up, right? If you put your money in a 3-month notice account, right, you've got to give 3 months notice to get it out. If you tie your money up in a savings account, in a time account with a 2-year maturity, that money is in that account for 2 years. You can't get it out, or if you do, you pay a penalty. So there's a lot of things in there. When they're worrying about hyperinflation, oh my goodness, money supply is increasing, we're going to get hyperinflation. Hyperinflation happens when everybody dumps the currency. They get rid of it. They buy white goods with it, and valuables and jewels and furs. They transfer it out of the country. They exchange it for something they like better, like the US dollar. That's what they do when there's hyperinflation, is they dump it as fast as they can. Now, if they've tied it up in time and notice deposits, they can't do that, can they? I mean, you can think of hyperinflation as a run on central bank, really. Run on a government. Like a bank run, when everybody tries to withdraw their deposits all at once. And what they're trying to do, really, is exchange their deposits, what's in their deposit accounts, for typically physical currency, right? Although, that it's called a bank run. And when that happens across all your banks, you have a collapsing banking system. But sometimes it just happens on one bank, in which case people might just try and move their money into a different bank, but it's still a run on the bank. Hyperinflation is when you've essentially got a run on the government. Everybody is trying to dump the currency of that country all at once, and they're doing it not only outside the country, so the exchange rate is collapsing, but inside as well. So people are dumping the currency. The population is refusing to use the currency, in effect, or they're getting rid of it as quickly as they can. Let's put it that way. That's hyperinflation, and it's rare. I mean, episodes of hyperinflation are rare, and they're always associated with a number of things, really, which include things like political chaos, often the aftermath of a war, regime change, and also some specific effects like high foreign exchange debt. For example, Venezuela's hyperinflation, for example, was triggered by a terms of trade shock when the oil price fell in 2015, because Venezuela is an oil producer. It's an oil exporter, so it was negative terms of trade shock. They were very dependent upon the oil price staying up, and it collapsed. But when you actually look at what was going on in the country, you'd got an extremely weak supply side. You'd got a extremely corrupt and really quite brutal government in place, which is still in place now. You'd got a partially dollarized economy. I mean, lots of people, even then, were already using the US dollar, and there was an obvious thing to exchange to use instead. And so the population really just dumped the bolivar in favor of the dollar, and that's still going on now. And that is why 6 years on we still have hyperinflation in Venezuela, because essentially nobody wants to use the bolivar. Look at Zimbabwe. I mean, Zimbabwe has never come out of hyperinflation, really. Yep. Absolutely nobody wants to use the Zimbabwean dollar ever. They'll use anything except it. So I think sometimes when people talk about hyperinflation, they need to understand what they're talking about. High inflation, like, I don't know, I mean, in my lifetime, 25% was high inflation. We had that in the 1970s. These days, 5% inflation is high. You know, these things, it's called a question of what you're used to, isn't it? Is not the same as hyperinflation. That's not to say it isn't worrying, but it's not the same phenomenon. Money printing does not, this is going to be a controversial statement. Money printing by the central bank or by the government, if the two are unified, doesn't cause hyperinflation, but it does reinforce it. It feeds it, right? What causes hyperinflation is the things that I've mentioned. And typically what the government is doing when it's printing money to feed the hyperinflationary spiral is actually trying to meet its obligations. Because if you think about it, if it's got foreign exchange debt, if it's got a lot of debt, say, denominated in US dollars, and it's, you know, in its national currency is bolivars, then in order to meet its obligations in US dollars, it's got to buy, or I mean, in case Venezuela's case, when the oil price collapsed, it wasn't earning the dollars anymore, so it then had to borrow them. And obviously, if it's borrowing them in its own currency, then it has to print more and more and more of its own currency in order to buy the dollars it needs to service its external debts.
Yep.
And so you get money printing. You also have the feedback loop that says the more money that is circulating in an economy, more prices are rising in an economy, the more money is needed to make it possible for people to obtain the money they need to buy goods. And so it's tempting just to print more and more and more of it because to meet demand. You know, it gets into a feedback loop. You can probably see that, can't you? But that is actually quite different from just high inflation, which is caused by all manner of things, and I think is not really terribly well understood by anybody. I mean, the inflation we have at the moment is not hyperinflation. And one of the things that interests me is when people talk about the dollar as if the dollar is going to collapse in a hyperinflationary disaster, hyperinflation is coming. And I'm going, yeah, what exactly are people going to use instead? Because that would be the question I would ask. What are they going to use instead? Because the available alternatives don't look terribly promising, really. We used to get the same question asked about the Japanese yen, because I mean, you know, in Japan they've got the highest debt in the world, and they've been doing QE for 25 years, and so the long-term question about, you know, when does the yen collapse in a hyperinflationary Armageddon? To which I say, well, they have an elderly population which has its savings in yen. Why on earth would they dump it? Exactly.
Yeah.
And in economics, sometimes you really need to think through incentives and think about, why would anybody do that? and then you can kind of see why shorting the yen is known as the widowmaker trade.
Yep. Yeah. And you know, so you know, you sort of just described number one, different kinds of money, but also, you know, as you mentioned, you know, for when it comes to hyperinflation, and you know, a lot of people simply when governments sort of you know, governments don't cause hyperinflation, but they do feed it. So I wanted to, and you know, when you talk about the inflation going on right now, you know, should central bank, you know, yesterday the Fed came out and, you know, they're quite hawkish, and, you know, should central banks be raising rates right now? Because sort of the thesis is that, you know, a lot of the inflation we're seeing right now is caused by supply chains, etc. So in order for the supply curve to shift outwards, it's how does raising rates actually help that? Does that do anything at all? And should central banks actually be raising rates over the
Well, this is an interesting question. I mean, the Bank of England actually raised rates today.
Yep.
A little bit. And most of us are going, well, what was the point of that then? Why? Because they've raised it by like 15 basis points. It's tiny change. I think, what's the point of that then? But I get the sense. I read the letter that the Governor of the Bank of England sent to the Chancellor, because he's obliged to write to the Chancellor explaining why inflation is so far over target and what he's going to do about it. And I think a lot of partly it's that the outturn on inflation has turned out worse than they expected. And so there's maybe a feel that they need to do something. I also got the distinct impression that there was a feeling that they needed to raise rates now, because once the oh my God variant of COVID gets going, they won't be able to. Yep. They'll be under pressure to reduce them. I got that as well. But being more serious for a minute, what they're saying, and in the UK this is complicated by Brexit, is that the labour market is pretty tight, and so they're going to get looking ahead, not beyond the short term. They're looking 18 months ahead. They're saying if it stays tight as it is now, we're going to be seeing demands for increased wages. We're going to be seeing employers raising wages on a widespread basis, and to attract labour, because labour is tight, and that is inflationary. Now they have a point. The question is whether it's going to stay tight. In the specific case of the UK, I would say there is an argument that it could stay quite tight because of the actions of the government in clamping down on immigration. But in particular the effect of Brexit, which has made it much more difficult for people from the EU to come and work in the UK. So we are suffering labour shortages already in several sectors because of that. Some of those sectors are public sector though, so like our NHS and things like that, and it's hard to see how that would translate necessarily into higher wages. It's more likely just to translate into shortages and rationing really, which is the alternative. But in the private sector, labour shortages do tend to result in rising wages. So that would be what they're leaning against now, is the possibility that the tighter immigration regime in the UK and also the ongoing problems we're going to have with import duties and things like that will mean that inflation will become entrenched. So I'd say they're leaning against that, but to be honest, 15 basis points is more like a shot across the bows, really. I don't think it's a serious piece of policy.
Yep. Mm-hmm.
And as far as other central banks, I mean, actually the ECB is almost going in the opposite direction now and saying, well, we're going to reduce our purchases a bit, but we don't expect to raise rates in 2022. And the Fed is doing a hawkish act, which looks to me like trying to get the markets to do their tightening for them, which is fun.
Yep. And the market is sort of expecting, I think, 3 hikes in 2022. And
yeah.
Yep.
But there's also the interesting argument that, sometimes I think, you can be a bit too macro about interest rates and inflation and things like that, and it gets things get lost in the weeds.
Yep.
And I think that they really need to have a good look at demographics, because when you've got a lot of your population living on fixed incomes, then an interest rate rise is potentially inflationary, because it means that people on fixed incomes will have more money, and people are notoriously unable to tell it's known as money illusion. Everybody suffers from money illusion. You have a pay rise, you're going, I've got more money, and you haven't noticed that actually prices have gone up, so you actually haven't. But it does mean that people on fixed incomes potentially have more money, and that could be inflationary. So interest rate policy is a little bit complicated by demographics, and I do think the central banks should look at it a bit more carefully than they do. There tends to be this knee-jerk, oh, we've got inflation, we need to raise interest rates. And I'm going, maybe you should kind of think about, what's going on in your economy and the way economies are changing and things like that. Actually have a closer look at it and think about what's best to do. MMT, an MMT argument, there's argument is that raising interest rates is not inflationary, is deflationary, not inflation, for that reason.
Yep. Yeah, and is what we're seeing right now, would you consider that to be MMT? Consider in a way, MMT is sort of the direct monetization of debt, but even though right now what we're seeing is, as I understand it, when the treasury issues new bonds, or when the treasury has an auction, so the primary dealers of the banks buy from the treasury and then they sell to the Fed, and then the Fed gives the primary dealers bank reserves in exchange for it. So would that still be considered MMT, or would it have to be the direct monetization?
Well, it's an interesting point, because technically what the Fed's doing, and indeed other central banks are doing, is indirect. I mean, they're buying from the secondary market. They're not participating in primary auctions.
Yep.
So it's not direct monetization. But it arguably is indirect, because certainly if the Fed has been buying every bond, buying up the equivalent of every bond issues. It's not actually been buying those particular bonds. It's buying bonds to the value of. But we're now in the realm of crypto people's favorite word, fungible. I mean, government bonds actually aren't fungible, but when the Fed is buying, it can look a whole lot as if they are. So what the Fed is actually doing is taking duration out of the market, so everything's shorter term, right? So, and that makes everything more liquid. It also creates some risk for the Fed and for the government, but that's another story. But that's what they're doing, is taking duration out of the market. So, and it has the effect of kind of financing government in two ways. One is because, like I said, there is an expectation they're simply going to buy up everything. And that is a widespread expectation. And secondly, and I think more importantly, because they're controlling the interest rate on government debt. If there's an expectation that you've got a very big player in that market that is standing ready to buy everything, right, then that player is setting the price. So whenever you've got a central bank actively doing QE, or saying it's going to do QE any minute now, right, in the market, then the central bank basically has taken control of the price of that asset, and indeed of all assets that relate to it as well. And I think that's the more pertinent point in relation to financing of government by central banks, is actually the central banks are controlling the price on government debt. And they're doing it all over the place. And that there is an argument that there isn't a real market in government debt at the moment, while central banks are doing QE. And indeed, there hasn't been for the last 10 years, decade or more, because somebody somewhere has been doing QE the whole of that time. The handoff between the Fed and the ECB in 2015 was hilarious. The Fed stopped, the ECB started.
Yeah.
Yeah. And indeed, we get to the point where if there is a real prospect of central banks saying we're not going to do QE anymore, the markets go, no! Yep. Somebody picks up the baton again. And I don't know. I genuinely don't know how we get out of this, because it's kind of become the whole way markets operate now.
Right.
That we have these very big players in the market, the central banks in the market, essentially controlling the price at which they buy assets, and the majority of the assets they buy are government debt. In the case of the ECB's control of the interest rates on government debt has been pretty explicit since 2012, which was before they started doing QE. It actually goes back to Mario Draghi's whatever it takes statement, when he said essentially we will do whatever it takes to keep the euro together. And what was necessary to keep the euro together was to prevent the spreads on Eurozone government debt from widening so much that some governments ended up in distress and had to leave the euro. Yep. So, and they've been really living on that one ever since. So the PEP that they've been doing during the pandemic, where they've been buying government debt, really unlimited quantities of it, has all been justified in the name of monetary policy, in the name of keeping the euro together. Christine Lagarde, when she took over from Mario Draghi as ECB chief, did a bit of an oops very early on when she said it's not our business to control spreads, and the spreads on Eurozone government debt promptly widened, and the ECB had to put out a statement saying, no, that wasn't what we meant. Because controlling the spreads on government debt in the Eurozone is exactly what the business
Right. That's what they
European
needed.
Central Bank is. And you can call that financing of government if you like. It kind of is indirectly, because it does make it possible for governments to borrow more cheaply than they otherwise would be able to without that backstop. And we've seen that prior to 2012, we saw just how expensive for governments like Italy and Spain, Portugal, and let's not even mention Greece.
Yep.
Just how expensive the borrowing could be if the ECB wasn't backing it. And interestingly today, because the ECB put out a statement which, having said we're not expecting to raise interest rates, they did say they were going to taper off their PEP purchases a bit. And even though they said, we're aware that this creates issues for Greece, because Greece has been included in the PEP, whereas it hasn't been included in QE, right? And we're aware this causes for issues for Greece, and we're going to try and find a way. We're going to find ways around that. Even so, the yields on Greek bonds went up by 10 basis points because everybody freaked out a bit.
Yep.
So it definitely is. The ECB definitely does control yields on Eurozone government debt. No doubt about it at all. So if you want to worry about government finance, of central bank financing of governments and malfunctioning markets, I think you could look at that rather than worrying about money supply. I really wish people would stop worrying about money supply, because money supply is not really the issue, except possibly in America, and we could talk about that. But for me, it's this control of interest rates that is the issue here.
Got it. And speaking of rates, one thing, one aspect that I wanted to cover was get your thoughts on. So LIBOR is sort of deep within the international monetary system, and it's benchmarking lots and lots of instruments and derivatives, and it's used to price various derivatives, etc. So how could SOFR sort of actually replace LIBOR? And why are banks sort of always pushing the replacement of LIBOR? Why are they always putting it off?
Well, the main problem with LIBOR is that it's increasingly useless, because it's I don't know how LIBOR works. LIBOR was a panel of banks essentially notifying the Bank of England every day how much they thought it would cost them to fund themselves in the interbank market. Right now, since the financial crisis, it all went pear-shaped in the financial crisis, as you know, when the interbank rates shot up to the moon, and some banks couldn't fund themselves at all, and then they invented the rates to try and get the LIBOR down to something sensible. And the Bank of England got into a bit of hot water about that, because we are talking the Bank of England here, really, because LIBOR is the London interbank rate, right? Now and you may ask yourself why it is that American assets are priced off a London rate, but they have been historically, and that's an anomaly as well, which is, arguably should be changed. And I know that the Fed wants to do that. And banks, I don't think the banks have been resisting it, really. It's just that there are real technical issues with SOFR, actually, which I'll talk about in a minute. And I'm not happy with SOFR as a rate, to be honest, as a replacement for LIBOR. But the real problem is that since 2008, the interbank market has died. Banks don't really fund themselves in the unsecured interbank market anymore. There's very little activity in it. They mostly fund themselves in the repo market. And so LIBOR, in a way, even with all the history, and there's this huge history of the shenanigans around it and the rate fixing and everything else, and people not wanting to be used for that reason. But the real reason is just simply there's so little activity in the interbank market that even if banks are honest in their funding rates, the funding rates don't make a great deal of sense because it's not really a functioning market anymore. That's the problem with Libor. Now, the problem with SOFR is slightly different. Obviously, the banks are funding themselves in the repo market, so it actually kind of makes sense to use the overnight repo rate. The problem is that the world and his wife is funding itself in the repo market, not just banks. You've got hedge funds and all sorts of things in there funding themselves in the repo market. And so one of the things we found, we found this back in September, was that the Fed was having to intervene in the market to dampen volatility in SOFR. And that means, in effect, given a backstop to hedge funds. And at that point, I think you need to be looking for a better rate than this. And I think there might be some thinking around that to do with why SOFR is proving quite tricky. I personally think the Fed should be looking at what stuff it's done more recently. So looking at, for example, they've just introduced a standing repo facility for banks. And for my money, I think they should be looking at that rate as their benchmark, not SOFR. Because that rate will act as a floor in the repo market anyway. And it would make far more sense to use a rate that's actually only used by banks rather than a wider market rate. But that's a personal view. That's what I think they should be doing. But this is quite a technical problem, really. But it really relates to the fact that SOFR is not simply an interbank rate.
Right, got it. And sort of to wrap up the podcast, I want to ask about Bitcoin, and we're gonna ruffle a few.
Of course.
And we're gonna ruffle a few feathers here, but
we were bound to get there eventually, weren't we?
Yep. And so, what do most Bitcoiners sort of get wrong, about a currency system that actually works versus what their worldview is? And in your world, what's sort of the best case scenario for Bitcoin?
Okay. I've been following Bitcoin almost from the start, and and it's clear to me this is another of those cases where something that was intended to work one way when it started, a bit like QE, has actually morphed into something entirely different. So just as QE, when it started, was meant to get banks lending and has ended up being a portfolio, interest rate portfolio adjustment tool. So Bitcoin was intended to be to replace, essentially to disintermediate banks in the payments system, and has ended up being a store of value, long-term actually investment asset, and a short-term speculative one. That's where it is now, really. And it's proving quite difficult, I think, to break it out of that into any kind of usable, payments medium, which is why we're getting all the proposals for layers, and so people saying, oh, well, it'll be the base of a payments network, and it hasn't got there yet because it mostly seems to be used as collateral, which is kind of not quite what we intended, is it? Now we've got the stablecoin phenomenon as well, which seems to be disintermediating as well. It's been quite interesting the way in which Bitcoin has kind of ended up being like the original and worshipped store of value in the crypto system.
Right. And
but other things are springing up to actually doing it, being the other things. So the medium of exchange in the crypto system right now is stablecoins. Yeah.
Yep.
And to some extent Ethereum as well, because of NFTs. Though even then Ethereum tends to be used as more like a protocol, I think.
And there's some altcoins like Solana.
Solana, yeah, those they're used more like protocols, aren't they, than actual
store of value.
Actual currencies at all. It's not even a store of value. It's more like a kind of a standard. ERC20 standard is like a standard. So we're kind of moving closer towards unit of account territory, really. And of course, the unit of account in much of the crypto system is the US dollar. Weirdly, but it is. But interestingly, it's becoming quite divorced from actual US dollars, and increasingly so, because even though stablecoin issuers are under pressure to have what they call reserves, as I've already pointed out, they aren't. They don't have reserves. They would only have reserves if they were actually banks.
Yep.
And they're not.
Yep.
So while they're not banks, I think Paxos might be. I haven't been able to. It is a trust corporation, I think, but I don't know whether it has a Fed master account. But if it did, then potentially it could have reserves. But what they're declaring is T-bills and deposit accounts in banks. Now that wouldn't be bank reserves, really. But they potentially could be narrow banks. Circle has said it wants to be what it calls a full reserve bank, and I call a narrow bank. It said it wants to back all of its stablecoin, its USDC, with short-term cash instruments, T-bill. It said it was going to make it cash and T-bills, but then it seems to have included commercial paper in there, and I'm not quite sure what that's doing there. So there's work in progress there, I would say, but you can see where they're going with that. And then Pax and Gemini are a little bit further down that path, and I think there will be regulation at some point forcing them to do it.
Yep. And
any stablecoin issuers that don't want to do that will have to operate offshore. So I'm seeing a kind of a bifurcation stablecoin industry, if you like. But in terms of economics, I think where Bitcoin specifically goes quite wrong economically is it got taken over by kind of Austrian hard money cranks at some point, which I was a bit sad about, kind of gold bugs. But back in the day, but in the sort of early days after the financial crisis, I used to have long arguments with gold bugs who wanted a return of the gold system, of the gold standard, right? And they kind of all seem to have melted away, but lots of them seem to have converted themselves into Bitcoin standard people who want a monetary system based upon Bitcoin as a Bitcoin standard, like we used to have a gold standard. And there's a whole book about that. And so quite a lot of people seem to believe in that. Quite a lot of people also seem to believe that everything can work on a pre-funded basis. And I think actually in a way this is even more problematic, because when something's working on an entirely pre-funded basis, there's no debt anywhere, right? Then you either have to continually print money or the whole thing grinds to a halt. What the cryptocurrency system is currently doing right now is continually printing money. There is more money printing going on in the crypto system than anywhere in the financial system right now. You only have to look at DeFi. Yeah. Every time you turn around, there's more tokens being produced. And, we can argue about the definition of money. I mean, in the traditional financial system, we actually limit it to the M's. But if you were to look at the great Austrian economic writers like Karl Menger or Ludwig van Mises, they would say that money is the sum total of everything that is used as a medium of exchange in the economy. So all of those coins that are being borrowed, staked, and then new coins being produced against them, and then all of that is newly created money.
It really is.
It really is. So you've got out of control money printing in the crypto economy, and you've got it in a way because everybody thinks it's not happening because Bitcoin only has 21 million. It doesn't matter. You've got to look at all the forms of cryptocurrency that are being produced, not just Bitcoin. And they go, oh no, those are just altcoins, and going, yeah, I know, but they're being used. It doesn't matter whether you think it's as good as like this kind of sort of pristine base limited supply form of money, which is equivalent to RM0. It's all the forms of money built above it. If you can see Bitcoin is like M0, right? Then above that, you've got M1, M2, M3, M4, you've got MN in the case of you've got this just infinite pile of derivatives, which is what they are in DeFi particularly. It's kind of endless. So I think, and it's all kind of built upon a belief that it won't crash. It's a bit of a house of cards. No, it might not crash. Bits of it do crash. I mean, there's a rug pull every day, really, isn't there? Or a crash or a collapse or whatever every day. Out of it might grow something new and important. I personally think that, we have got, the internet and increasingly lots and lots of things going online that previously were footfall in shops and things like that. And the internet does need its own financial infrastructure. So it's reasonable to try and create it. And banks, whether we like it or not, banks are part of that. We're not going to disintermediate banks as Satoshi originally intended. They're going to become part of this system, or crypto is going to become part of the banking system. I think that's where it's going. But it is a transformation of finance as we know it into something much more suitable for an internet age, and that's a good thing. I just think, as with all kind of works in progress, if these things are evolutionary, and how they end up isn't necessarily how their inventors originally intended. Yep. And an awful lot of people fall by the wayside along the way. And that's kind of a necessary part of how evolutionary systems work. There are a lot of failures.
Yeah, agreed. And so in a way, do you think that, I guess like almost like at the end of the day, or like say like 10 years time or so, would you suggest that, Bitcoin is probably going to be roughly where it is right now? Do you think, it's probably going to dwindle down, and, there's obviously going to be a bunch of, Bitcoiners who are going to stay, hard on, but, hard as Bitcoiners, and, they're still going to continue owning their Bitcoin, but, otherwise, it becomes a rather meaningless part of the financial system.
I think Bitcoin will become obsolete.
Mm-hmm.
I think it will retain a curiosity value as an antique. Yep. And a certain amount of respect, because it was the first and for a long time the biggest and best cryptocurrency. But if I look far into the distance, it is a piece of technology, and technology changes. Yep. It's a bit, I keep saying to sort of putting out a picture of a vintage car and saying, do you still want to drive one of these? The fact is that when people talk about something lasting a long time, look 100 years from now, is anybody still going to be using Bitcoin? I would doubt it. In precisely the same way that if we look back 100 years, the cars people drove then don't resemble the ones now. It might be there are a few people still driving cars from 100 years ago, but they are vintage cars and they look after them very carefully, and they don't drive them on ordinary roads. So it's going to be superseded by better things. And I don't think that's a bad thing myself. It will be superseded by better things. And that might be evolutionary as well. So we might have Bitcoin Mark 26 in much the same way that we still have Ford cars now, but they don't resemble the Ford cars of, the Model T Ford, the famous Model T Ford invented by Henry Ford way back whenever it was.
1913 or something.
Yeah, about 100 years ago. So we don't have those, but we still have Fords.
Yeah.
So I think it'd be more like that, and I think it would be quite wrong to try and prevent that happening, because we need technological progress. We need technology to advance.
Absolutely.
It's part of what we are as a species. We do technology. We always have. I mean, there's actually nothing new about technology. We've been doing technology, inventing new technology since we invented the wheel.
Yeah.
The wheel was a new form of technology, and it revolutionized everything.
Right.
There have been these incredible revolutionary leaps at various times in human history. Compared to the wheel, I don't think Bitcoin's that revolutionary.
Yeah.
Right. I actually don't think it's that revolutionary compared to the revolution in payments that we saw in the 1980s. The trouble is that almost everybody in crypto is too young to remember what it was like before then. But if you can imagine, if you can imagine a world where nearly everybody was working in cash, hardly anybody had bank accounts, and that if you wanted to make a payment, you could write a check, piece of paper.
Yeah.
You could go to the bank and withdraw some cash. There were no ATMs, by the way. So you'd have to go to a bank during opening hours and get some cash over the counter, and then make a payment in cash. Electronic point of sale, EFTPOS as it used to be called, was introduced in the 1980s. Now, I think for young crypto people today, they've grown up with it. I think they can't imagine a world in which that doesn't exist. But I grew up in a world where it didn't exist. And I remember when it was introduced, and it was revolutionary. I'm struggling to see how Bitcoin is any more revolutionary than that. It actually, and in terms of economics, it actually reintroduces some very old concepts, which is the idea that you can have a world with no debt, which was a lot of the basis of Bitcoin when it first started. There's a great belief that we didn't need to have any debt, so we could get rid of the debt-based, credit-based financial system. Our financial system is credit-based.
Yeah.
And there was a lot of movement at the time about saying, could we have a financial system which wasn't credit-based? And although I could see the argument, I could also see that if you had no credit in your system at all, nothing, then you would have an incredibly illiquid system.
Yep.
And as I said, then you end up with what you have now in the crypto system, which is that creating lots more money all the time. And you actually also have a bit of credit creation as well, I have to say, going on as well. And things like Celsius, I mean, they are lending, but there's not a lot of actual lending in the crypto system. It's mostly staking and collateralized tokenizing another asset, and it's mostly that. And like I said, I think that's unsustainable unless it's actually impossibly illiquid, unless you keep creating new money, because you're constantly locking up your money all the time. If you're constantly locking up your money, you've got to constantly be creating more. Otherwise, the whole thing just kind of
apart.
Otherwise the whole thing just grinds to a halt because everything's just locked up all the time. It's just incredibly illiquid. And I don't think that that people trying to operate without credit have totally understood just how illiquid things are when there's no credit, and also the way in which credit reappears in disguised forms the moment you try to solve your liquidity problems. So in Lightning, for example, I pointed out right from the start that there is quite a lot of credit risk in Lightning, in the Lightning network, that it involves lending. Even just to make a payment, you've got to borrow somebody's coins. Admittedly, instantaneously, but you've still got to borrow them. Yep. And it might not be instantaneous because they don't get them back until the payment is completed. The other one because it's pulled, right? And then you get this cascade of repayments. And if it doesn't actually complete, then you don't get your money back. The coins can mysteriously disappear. And things like that. You have this credit and credit risk reappearing in new forms that you hadn't thought of before, simply because you're trying to solve a liquidity problem. Because credit, yes, if you have too much of it, it's a problem. But equally, if you don't have enough of it, it's a problem. Yeah. You need a kind of Goldilocks level, and we're not very good at Goldilocks, I don't think.
Yeah. Well, Francis, I think there was a fantastic interview. I think we were really comprehensive about so many different topics. And is there anything that we haven't covered that you wanted to cover or you wanted to mention?
No, I'm very happy with what we've covered. Actually, I think it's been a really good. I've talked a lot, but hopefully coherently, and hopefully it will help people to understand. Yeah,
I think I think there's definitely a lot to learn in terms of monetary economics for a lot of people, and so I think
there is one thing I wanted to mention actually, because I mentioned it earlier and we didn't come back to it, which is when I said that I thought money printing in the United States potentially is causing some inflation, but the problem is not the Fed; it's the US government. Now, I'm an advocate for helicopter money, right? It's part of my People's QE thesis, is that one of the tools that a central bank should have is the ability to give money directly to ordinary households and businesses, like, rather than trying to go through financial markets and hope it trickles down, which it might or might not. I think they should be able to do that. But I also pointed out that unless we have something like a central bank digital currency, and we are creeping in that direction, but until we have that, the money would have to be distributed by the fiscal authority. If you look at what the US has been doing, it did 2 helicopter drops, one in the CARES Act early in the pandemic, and it's doing another one, right?
Mhm.
Now, I argued against the one in the CARES Act, and the reason I did is that at the same time as they were proposing to dish out all this helicopter money, they were also closing down large amounts of the economy. And the whole point of a helicopter drop is that people should spend the money. But when you're closing down the economy, people can't. And so an awful lot of that money was going to get saved. I thought they should do targeted welfare drops to people who needed it rather than indiscriminate handouts. And indeed, a lot of the money was saved. When I looked at the American saving rate at that time, it absolutely hit the roof. And one of the things that's driven up crypto prices actually has been the stimulus money, not just from the Fed, but also from the US government. It's been one of the things that's gone into crypto and driven up prices there. And so now the economy is reopening and people are starting to spend that money, and they're talking about doing another helicopter drop. And so I think there is a serious risk of inflation. I think that is a driver of the current inflation that we have. So having said in general money printing does not cause inflation, I think in this case, because they did a helicopter drop at the wrong time and are now doing a helicopter drop at the right time, but on top of the one that they did at the wrong time, and they've got the wrong one now coming out into the economy in a rather unpredictable and unmeasurable way, it's causing inflation. It was bad policy. If you're going to do helicopter drops, the amount of kind of sort of disconnected thinking around this has been incredible. So why are you trying to raise aggregate demand while you're shutting down half the economy? This doesn't make a great deal of sense. Why don't you wait? Why don't you focus your money, your attention on supporting people who need to, so that they can stay alive, and businesses so they can be safely mothballed, and then you can keep your helicopter drop for when you reopen your economy and you want to give people a little bit of extra spending money to encourage them to go out and spend, because they might be a bit scared to, I don't think they got policy quite right, and I think they're going to pay the price for that in terms of higher inflation for a while. And furthermore, I don't think that the Fed can do anything about it.
Yep. Yeah, got it. With that, and thank you so much for being on the podcast, Francis. It was awesome. It was fantastic. So, thank you for being on.
It's been an absolute pleasure. It really has. I've really enjoyed it.
Thank you.